Good afternoon and welcome to today's session of the Covered Options Online Learning Club, otherwise known as Cool Club. We're fairly laid back here at the Cool Club, and so if you have questions at any time, feel free to type them into the questions box. Dave and Lori will get them to me. Hope you enjoyed today's session, and if you're new, I hope you'll join us for other sessions. I'm your host, Paul Madison, and resident Cool Club dude. You can write to me at the Cool Club discussion list, which is cool_club@bivio.com. I just want to make our normal disclaimer about options. Options do involve risk and are not suitable for all investors. All club members or individual investors should understand the risks associated with options or any other investment instrument before investing. And on the slide, there's also some recommendations on where you can go to learn about options as well as stocks. For any of you that are new, what is Cool Club? This is a weekly 30-minute session where we will explore the thought processes associated with doing covered options. Normally we'll be looking at actual trades, but some nights, like we will today or afternoon, we'll explore some side topics that are related to selling covered options that I believe will help you better understand options. Often asked question is, why does Paul only believe in selling options rather than buying options? Isn't it just two sides of the same coin? Well, you're in luck, because we will explore this topic at tonight's session. Next week we'll also do an extra topic about what you need to do with your broker to be able to start selling covered options. And as I mentioned last week, I'd love other people's experiences with brokers other than Fidelity, Schwab, and Options House, as these are the only three that I can speak about directly. And after we get done with these two sessions, then we'll return to talking about covered calls and cash secured puts. I've put calls first and puts second. Depending on what's going on with the market, I'll feel free to switch those two around if it makes more sense to talk about puts first. Cool Club homepage. The link is www.bivio.com/cool_club. Both handouts and recordings are available under the presentations link. If you haven't joined our discussion list, you can do that here. Under resources and tools, there are a lot of things, but in particular are the Excel spreadsheets that I call the cool tools. And finally, to be able to check the schedule and register for upcoming events, you can go to the meeting dates and times. So tonight we'll spend most of our time on why I sell rather than buy options. We do have a few outstanding trades that we have discussed before that we'll do an update on. And then depending on our time, we'll have an open forum discussion around any questions on covered options, stocks that you'd like to look at options on, and or questions around the tools. So tonight we are going to explore both sides of buying and selling options. I hope it'll help you understand why they are not just two sides of the same coin. To help us understand this, I want to explore something that we all deal with in our modern lives: property and casualty insurance, what we usually think of as our homeowner's insurance. So when you pay your insurance premium, oh, isn't that interesting? They call it a premium just like we do in options. Oops, sorry, I guess I digress. So when you pay your insurance premium, your insurance policy has some value. That value can be calculated and is basically the amount of the coverage of the policy times the probability per day that you will sustain some type of loss times the days left on the policy. You pay the insurance company to take a risk. That's how they determine what to charge you. When the policy expires, in other words, there is no time left on the policy, then the policy no longer has any value. So it eventually counts down to zero. We'll come back to our comparison with insurance in just a second, but I want to do a little sidebar here. And I want to remind ourselves what drives option prices. Those of you who have been around for most of the Cool Club sessions will remember this. There are three main things. I don't know why it says two there, but there are three. One is how long the option has to expiration. In other words, the longer time an option has to expire, the more it is worth. The second is the underlying stock price. And the third component is volatility, which is another name for fear and greed, and we got to learn all about volatility last week. When an option is out of the money, all of its premium is viewed as what is called time premium. And it is called that because it only has value while there is still time left to expiration. Obviously, no one would pay any money to buy an option to buy a stock out of the money after the option reached expiration. Once an option reaches expiration, the time premium is zero. And the value of the time premium is a bit different for out of the money and in the money, so let's dig a little deeper. For out of the money options, which for calls is strikes above the market price, all the premium is viewed as time premium. And so in our example, we have an out-of-the-money call. Strike is $55 and the premium is 50 cents. So the time premium equals the premium, or is in fact 50 cents. For in-the-money options, we have to first calculate what is called the intrinsic value, which is the difference between the current price and the strike. The time premium is the amount of the premium over and above the intrinsic value. So we start with an in-the-money call with a strike of $50, and it has a premium of $3.10. So that $50 strike is lower than the current stock price of $52.50, so it is in the money. The intrinsic value is going to be the price, stock price, minus the strike. So $52.56 less 50, or $2.56. And thus our time premium equals the premium minus the intrinsic, $3.10 less the $2.56, or about 54 cents. And you can see both of these options, one is about $2.50 out of the money, and one is $2.50 in the money, give or take a few pennies. And so you can see that in this case the premiums are real close for how the time premiums, are real close for the amount they're out of or in the money. That isn't always going to be the case. Sometimes you'll have more volatility in one direction or the other. Just to help drill this in a bit more, here are some examples looking at a call option chain on SPY when the SPY was, you can see right here, just a little under $144. Let's first look at our 146 strike, which is called out of the money because the strike price is higher than the current market price. Last premium that was traded was 87 cents, and so all of that would be considered time premium since it's out of the money. Next, let's look at a 142 strike. It's in the money, and as the strike price is below the current market price, the last premium traded was $3.18. To determine how much of that is time premium, we have to calculate the intrinsic value. Intrinsic value is the stock price, $143.97, less our strike of $142, and so that's $1.97. And you can see our time premium then is the $3.18 less the intrinsic $1.97, gives us a time premium of about $1.21. I just wanted to roll through a few of those so you could get a feel for how to determine what the time premium actually is. So we've sidetracked long enough that we need to remind ourselves what the buying insurance slide looked like. So when you pay your insurance premium, your insurance policy has some value. But when the policy expires, in other words, there is no time left on that policy, then the policy no longer has any value. By the way, all of the insurance premium would be viewed as a time premium. Now let's look at buying options. When you buy an option, some or all of the premium you pay will be a time premium. That time premium value can be calculated by looking at how much of a price gain the underlying stock would have to reach the strike times the probability per day of reaching that level, and assumed volatility would come in here as well, times the number of days left. But the calculation itself isn't as important right now as knowing that when the option expires, there is no time premium left. It is zero. If stock prices haven't moved like you thought, then as a buyer of an option, you have not been able to use your option to purchase or sell shares. You have just paid to protect yourself in case the price moves in a direction you didn't like. Just like you didn't get anything from the insurance if your house doesn't burn down. So with both options and insurance, there are two sides to the coin. Let's look first at the insurance coin, and there's the insurance company or the seller. They get to set premiums. They select premiums where they think there will be a large probability that they will get to keep them. They want to know there is a very small probability that their insurance will be used, and they will have to make, and so that they don't have to make a large payout. By the way, an insurance company's income from premiums must exceed their payouts for them to be able to have a profit. On the other side of our coin for insurance is the insurance policyholder or buyer. They strive to buy at the lowest premium they can find. They know that there's a very large probability of spending their premium and not getting anything in return. So how does that relate to covered options? Well, let's look at the same thing on our options. As option sellers, we get to set our premiums. Of course, we are not guaranteed there will be any buyers at our premium. But if we have made good selections, once we have sold, we know there's a large probability of keeping the small premium and a small probability of losing a large amount. And we'll come back to what that large amount might be a little later. Option buyers go out and buy the best premium that they can find. They know, or they should know, that there's a large probability that they will lose the premium they paid. They also know there's a small probability of getting a large payout. So what does a large probability mean? Of the options that are still open by the time they reach expiration, something like over 75% expire worthless. That means they are never used. The sellers never have to do anything, and the buyers never get a payout. Let's delve a little deeper into the two sides of the specific option types. First, on calls. A buyer of a call is speculating that the stock is going higher. If right, the buyer buying the option allows them to enjoy a significant amount of the price increase without having to buy the underlying stock. Their cost to do this is the price of the premium, which is a fraction of the cost of the stock itself. However, if they're wrong, they lose the premium. Now the seller of the covered call, that is what I am, and I hope you are as well. When I sell a covered call, I'm making the assumption the price of my stock is not going much, if any, higher. In fact, I'd be happy selling it at the strike price, but I'm not sure it'll get there. So I'm trying to earn a little money in the meantime. If I am right, then I get to keep the premium. If I am wrong and the price does go up significantly, then I get called away and I sell my stock for the strike price plus the premium net of commissions. The philosophy that I operate under and I teach in Cool Club is that I only sell covered calls at strike levels that I am more than comfortable letting the stock go at. If you cannot honestly let the stock go at the strike price, then you should not be selling a covered call. This is an extremely important thing you need to keep reminding yourself of. And finally, I believe my risk as an option seller on calls is absolutely no different than when I sell my stock outright and shortly after that, the next day or maybe even still that same day, the price takes off. It is a loss of opportunity and nothing more. Now let's look at the cash secured puts, or just puts, I guess, because we're going to look at both the buyer and the seller. A reason that someone can buy a put is because they own a stock and they want to provide some downside protection. This protection is called a hedge. If they are right and the stock goes down, then the option will go up and the gains on the option helps offset losses on their underlying stock. If they are wrong, they lose their premium, but their stock has gone up in value. Notice how similar this scenario is with insurance. But I don't like to pay money for insurance, so I sell puts rather than buy them. As a seller of a cash secured put, I believe a stock is not going significantly lower, and I'm going to sell insurance to the guy who wants to protect his price. If I'm right, I get to keep the premium and don't have any other obligation. If I'm wrong, then I will buy his stock with the cash I have used to secure the put. My price will be the strike price defrayed by the premium I collected, all net of commissions, of course. This is not a problem to me because I decided I would be happy with this outcome when I sold the option in the first place. My only risk from being exercised on a cash secured put is no different than when I buy a stock one day and shortly thereafter watch the price go down. At least if it does go down, the fact that I collected an option premium means my purchase was made at a slightly lower price than if I had just bought the stock outright at the strike price. So let's recap. I hope you can see that buying and selling options are very different. I also hope that the analogy of the insurance helps you better understand options. And a large advantage for the sellers is that they collect time premiums, which is a value that wastes away to zero at expiration. And finally, it's important to remember that a large percentage of options that are open to expiration expire worthless. All right. At this point, Lori, let's see if we have any questions out there.
Ron Elliott is asking if there's any circumstances that would lead you to sell an option that's in the money.
Yes, but I think, Ron, let's hold off and explore that. That might be a whole topic in itself. So the answer is yes, there would be times that I would consider it, and I'll go into the reasons when I do a full session on that, if that's all right.
Yeah, we had another question like that, but we had the same answer, so I don't see anything else here right now.
Okay, very good. We have a few outstanding trades left that I thought we'd spend a little bit of time talking on. And just kind of a reminder, any of the examples that I talk about, trade examples that I've done or that others have brought to the table, are only for education purposes. We're not making any recommendations to buy or sell stock or to buy or sell options, sell or buy options. And as always, you needed to be doing your own research and or consulting a professional before you invest in anything. So the first one is one that was posted out on the Cool Club, trade that was around McDonald's. This is a McDonald's underlying position that's been owned for a while and had good gain on it. The individual felt like the fair value on the stock was around the 91 to 92 level, and they were comfortable with selling a 92.50 call for October 20th expiration. That was actually an in-the-money call along the lines of what Ron just asked about, slightly in the money by 55 cents. Collected $1.77, so learning from tonight, 55 cents of that is intrinsic, and $1.22 would be time premium. The APR when collected was 22%. And a little less than 2 weeks later, McDonald's had pulled back about $2 and able to buy to close the position at 50 cents. And because that was less than half of the time frame and actually collected 3/4 of our premium, we actually improved our APR from 22 up to 32%. So this is a real classic example of a covered call against your underlying position. Then we had a couple trades that were open from last week's posts. First was a coach put. It was sold open on September 25th, a $55 strike for October 20th expiration. Collected $1.80 and the APR was 45% at the time. That particular option, Coach, has continued to move up a little bit. That option has moved down in value and is only 85 cents. And so that means, and this was one that one of the club members had posted. So I don't know if it's still open, but if they wanted to, they actually could buy it back and they would have captured over 50% of the premium and done that in just a little over a week. And there's obviously still 2.5 weeks left. QSI was also a put, sold open on September 26th. It was a $17.50 put for October 20th expiration. Collected 55 cents. APR was about 45 at the time, or a little greater than 45. And that has not changed much. QSII is still right around the I didn't look at the end of today, but 17.75 level. And the last I looked at that premium, it was still about the same place as where it was sold, the 55 cents. So those were some closeout on trades that we've had in previous sessions. Next week at 8 o'clock, October 10th, we will, as I said earlier, do a session on getting started with your broker on covered options. And at this point, we can kind of open it back up if people have questions or want to look at a particular option or options on a stock or have questions about the tool.
Paul, this is something I think you've touched on in previous sessions, but maybe it's a good time to reiterate it. Malcolm is mentioning about when options get executed, especially if there's a dividend involved.
When they're exercised early?
Yeah, that's what he meant.
Yeah, typically options, for the most part, are not exercised early. One of the exceptions, can be some others, but the primary exception is when you sell a call against your stock Depending on kind of the math, it may be advantageous to the buyer of that option to exercise early so that they are the owner of record and can claim the dividend. So they would have to exercise the day before ex-dividend, and that can happen to you. And what that means is your stock is called away from you, and the buyer of the option will get the dividend rather than you. Nothing like that happens on the put side, because obviously that is about selling you stock rather than buying you stock, and somebody's not going to try and sell early just so that you get the dividend instead of they do. So the same scenario doesn't not happen on puts. It's only on covered calls.
Okay, there's no other specific questions unless somebody else has a stock that you want to talk about. Maybe.
I'd like to mention that Dave, who's helping us out in the back room, mentioned that he discovered something on the broad market or the index ETF cool tool where when you click on the links for the Bollinger Bands, it isn't updating to the current price. It's always still going back to September. And so I'll have to take a look at that and see if I can't get that to behave a little better. So if you've noticed that, I'm aware of it, and I'll see what I can do to fix it. Once you're there, you can obviously drag the dates and make sure that it includes or is at the up to the current date.
I guess I'm also interested if anybody has any options trades they've done recently that they want to share. Might be interesting too. But if not, maybe you get out early today, Paul.
People must have beautiful weather they want to get out to.
Yeah. I don't see any other questions or comments or anything.
All right.
Jay is asking what kind of brokerage fee you have to pay when you sell an option. And I imagine that's something you might be covering a little bit next week, right?
It depends on the broker, and we've talked about a little bit when we've talked on selling options that some brokers, for instance, Options Express, theirs is like a $15, and that covers the first 10 contracts, and then they charge you $1.50 for every contract over 10. That's on a specific trade. Other brokers, Schwab and Fidelity, tend to charge their normal trade commission. So in Schwab, I think that's $8.95, Fidelity $7.95, and then they both charge 75 cents per contract over and above that $8 or $9. And so in each case, you just varies significantly from one broker to another. You need to research it. The virtual trading simulator, I think, is based off of Options Express, if I remember correctly, and so you'll see that kind of $15 charge when you sell up to 10 contracts, and also 15 to buy it back. That's one of the higher that I have seen, and I wouldn't do that. I would look for better rates, and there are certainly better ones out there.
I think somebody was explaining Options Express setup is good if you're doing a lot of contracts. It ends up being less than a lot of them, but for one or two, I think it's pretty costly.
Yeah, and that's true. You can tell that people are aimed at either the small trader or the large trader, and their commission schedule can in fact favor one or the other to kind of align with the kind of business they want. So that's a good point, Lori.
Yeah, Don Lina is sharing that Scottrade charges $7 to buy and sell options with a $1.25 contract fee, but they charge $17 if it's assigned and exercised. Yeah,
that assignment fee is one to watch too. Most brokers just the assignment is just the same as a normal trade. So if your stock got called away from you, it'd be like selling your stock. So at Schwab or Fidelity, that'd be either $7.95 or $8.95. But there are some brokers who have an assignment fee that's significantly higher. I've heard 17s and 20s. So it's important to kind of understand the entire commission schedule.
And somebody's asking what Fidelity charges, right? They're curious what Fidelity charges to be assigned and exercised.
Yeah, when you are assigned at Fidelity, it's just the same as if you did a stock trade. So if you're called away on your stock, then you're going to be charged a normal stock trade, which is $7.95. Or if you have a stock put to you, if it's assigned and put to you, then it's a normal stock trade of $7.95.
And we're also getting the feedback from Malcolm that Schwab is $8.95 a trade and 75 cents a contract. And he hasn't seen assignment or exercise, but I have. It's your regular brokerage commission.
Yeah. Fidelity and Schwab do not call it an assignment fee. They just call it a normal stock trade commission when you are exercised. So when your stock's called away, you pay a stock trade. When you have the stock put to you, you pay a stock trade.
So Paul, Malcolm wants to know if we're still patiently waiting for SPYs to drop so that we can sell puts on them.
I am. I don't know if you are, Malcolm, but I am. But it's it feels like it's not. Our wait may not be all that much longer. We'll do a session on brokers next week, and by the next week, it may be time to be looking at selling puts.
Who knows? Maybe after the debate tonight, we might have an opportunity.
Yeah, that's true too. Indeed. Well, very good. Feels like we kind of have hit the end of the discussion out there. So at this point, I guess it's not really quite night yet most places, but I'm still going to say good night and good selling.